are probably starting to see some moderation in exports, which has actually been the main driver of the Chinese economy in the first half of the year. And I think that's also consistent with some indicators that we've seen recently. For example, the negative surprise in the U.S. manufacturing PMI. And in yesterday's numbers, we actually noticed that the tech exports still are doing pretty well, but there are actually some slowdown in the traditional consumer products, so which seem to suggest that there could be maybe some slowing momentum in the end user economies like the U.S., for example. But actually, looking at the autos data, I have to say that maybe the impact of the EU tariffs are actually not very apparent in yesterday's data as far as I can see. So, but that's definitely the risk that we will be watching, especially for the U.S. election. If we really have Donald Trump coming in and impose the tariffs on Chinese goods, and that definitely means that on a long-term basis, Chinese needs to rotate the economy from depending on exports to domestic demand, and that's really what the policymakers really have been trying to figure out over the last couple of years.
Of course, the market is looking to those tariffs, also the tech curbs from the United States, and front loading is taking place in anticipation of that. But do you think that this upward cycle that we're seeing, that there is a limit to this, because it's going to have to bite at some point? And how long do you think that this front loading can last?
So I think for the second half, we're probably going to see some softer export growth compared to the beginning of the year, because we've seen the support from the front loading. And also the U.S. economy is probably not growing as strong as what people are thinking about at the beginning of the year. So I think that's also going to weigh on the export momentum. And also looking at yesterday's trade data, we also noticed that exports to the Asian economies from China has slowed quite notably. And the Asian trade is normally a good leading indicator of the global trade momentum. And if we see this continuing slowdown in the trade with the Asian economies, I think that suggests that we could be maybe seeing some softer growth in the second half. But having said that, I don't think we should be extremely worried about an imminent U.S. recession. I think here we are talking about some slower growth, not as strong as the first half. But I think going in the second half, given that the domestic demand is not expected to pick up very strongly, the exports and net trade is still going to be very important to China.
An inflation reading is coming through tomorrow. Are you expecting deflation on the wholesale producer level to continue?
I think that's likely to continue. But on the CPI, actually, I think there's a chance that the CPI could be picking up a little bit, because we are seeing some firmer momentum in the pork prices recently. And we know that actually part of the weakness in the CPI over the past year we've seen is actually because of the decline in the pork prices. So given that food accounts for 1/3 of China's CPI basket, I think we could be maybe seeing some small improvement, but definitely it doesn't mean that China is out of the disinflation or even deflationary story. The property prices deflation, I think, it's been pretty entrenched, especially in the consumer durable goods. For example, we've seen some auto companies talking about doing a lot of discounts to encourage people to buy more cars, and we've also seen similar situation in the mobile phone sectors. So I think as long as the property sector doesn't manage to stabilize, this deflationary momentum is going to be in place.